the Fed hasn't been able to get inflation under control, in my personal opinion, because we have locked people up for 2 years and they do want to get out there and live and spend money, and they're doing it at a cost. They're spending their savings, they're racking up more credit card debt, they're doing all of these things, and it's going to have to get really, really painful before the Fed actually achieves its goal.
Hi, this is Dan Cooley. I am the content strategist at Princeton Mortgage. Here with me is Victoria DeLuce, the EVP of Capital Markets. Victoria, how you doing?
I am doing great. Absolutely no complaints, even though we have a big Fed number coming out, which is what we're here to talk about.
It sure is. So why don't we start right there? Let's start with like the absolute basics, okay? I know people already know this, I'm sure, but just in case, what issues are the Fed trying to tackle right now?
So the number one thing that the Fed is trying to tackle right now is inflation. So last year, we started to see inflation spike up a little bit, and the Fed kept referring to it as transitory. They thought that it wasn't going to be around for a long time. It was just a result of the pandemic, and they didn't think it was much of an issue. Well, enter the beginning of this year, they realized actually it is a bigger issue, and we've actually seen inflation go on an annualized basis. So this is year over year. That's the number one headline number that comes out. We saw it go from 7.9% up to 8.3%, 8.6%, and then capping out at 9.1% in June. That was the big CPI number that we received, and that was in June. This last month, for August, we saw the headline number come in at 8.3, which seems like it would be less, but month over month, it still continued to increase. And that's what we didn't want to see. We want to see it go in a different direction, which would be a decreasing month over month number.
Now, what have they done thus far to try to tackle this? So like obviously they're raising the rate. Everyone can say that, but what does that mean? What effect does that have?
So that is the number one tool that the Federal Reserve has in fighting inflation. So the thought or the theory behind it is that if the Federal Reserve raises the interest rate in which banks borrow from each other overnight, that's the federal funds rate, that if it's more expensive for banks to borrow, that will find itself into consumer interest rates in the form of car loans or mortgage loans or personal loans or any kind of loans that a bank would give. And that would cause borrowers to be able to spend less money because interest rates are higher. And if they're not putting money into the economy, that means the economy's not growing. As a matter of fact, they want it to slow. And that's the whole point of it. So we started this year with a federal funds rate of a target rate between 0 and 25 basis points. Right now, we're sitting at between 225 basis points and 250 basis points. And we have the expectation that the Federal Reserve is going to raise the federal funds rate another 75 basis points this Wednesday. That's almost, I believe actually it is 100% priced into the market currently. So for IMBs or independent mortgage bankers like us, we price to the bond market or the mortgage-backed security market. And that means that increase in the Fed funds rate, it's already in there. So you're already seeing that in your rate sheet. Now, the caveat is because we saw that CPI number go up 0.1%, it's actually 0.01%, which doesn't seem like a lot, but directionally it's the wrong way. Now there's talks of possibly having an increase of 100 basis points on Wednesday. So that's kind of where we're at right now.
Obviously, the market is not necessarily a formula that you can exactly know what's going to happen by plugging in certain numbers and whatever. But what should we look for? If they decide to increase it by 100 basis points or 1%, what does that look like for in our case the mortgage industry, loan originators specifically? What are the effects that you would imagine?
Well, actually going to back up just a second. So we have the announcement that's coming out on Wednesday. The announcement isn't necessarily the most important part about Wednesday. It's the comments that come afterwards from Jerome Powell. So we'll get the announcement. We'll learn if the Fed funds rate is going up by 75 basis points or 100 basis points. But then at 2:30, Jerome Powell will come out and give us his take on what the current state of inflation is, of the market is, of the economy is. And so it's what he says in those comments that's most important. Now, there are a few pretty interesting things happening right now. We have the Fed trying to fight inflation through higher interest rates, but a few interesting statistics came out recently, and that is that we have consumer debt has gone up month over month. We have the highest increase year over year in credit card debt that we've seen in over 20 years. So that's particularly alarming. We also have personal savings rate that has gone down to its lowest level since 2009. And so when you look at those two factors, and it makes you wonder, like, why are people out there still spending money? We know that we have runaway inflation. We know that the Federal Reserve is trying to curb inflation. But for the average person going out there and buying groceries and filling up their gas tank, like, they don't have another choice. What they do have a choice in is what they're spending their money elsewhere. We still have consumers out there spending a ton of money. Now, granted, we have borrowers, refinances are essentially dried up. We have the unintended consequences of super, super low rates for the last couple of years. And now borrowers are not wanting to move because home prices are still high. Interest rates are higher. They can afford less now. And then there's a tax implication on top of that. So when they move and they homestead the house, that their taxes can potentially go up as well. So there are all of these different factors and unintended consequences of low interest rates. And so the problem that we're facing right now, though, is when you lock an entire population up for 2 years and now everybody's out there trying to live life the best that they can, that's why we're seeing ourselves, at least in my personal opinion, in the situation that we're in. Regardless of what the Fed is trying to do, and they're going to push hard, and it's going to be super painful for the average consumer, but the Fed hasn't been able to get inflation under control, in my personal opinion, because we have locked people up for 2 years, and they do want to get out there and live and spend money, and they're doing it at a cost. They're spending their savings, they're racking up more credit card debt, they're doing all of these things, and it's going to have to get really, really painful before the Fed actually achieves its goal. Now, some other statistics out there, right now we're at between a 2.25% and a 2.5%, or 225 basis points and 250 basis points for the target federal funds rate. Analysts believe that that's going to probably top out at 4.5% to 4.75% by February of 2023. But possibly we could see in May of 2024 the first Fed cut. Now, granted, these are all just predictions from really, really smart people, but that's kind of where we're seeing the market go. So topping out the beginning of 2023 and then coming back down in 2024.